Yep. And I see there's a lot of people in here, but not everybody's talking in the general chat too. So, guys, if you make sure
it's fine. Listening is fine.
I know, but I want feedback. I want to see where people are at.
I get it. But yeah, so like if you have like specific issues of any kind, that's a good way to start off. Narwhal, okay. Simple doesn't always work, but too complex happens very fast. Yeah. You stick to something in the middle. I guess the question at that point is how you define too complex and in the middle. And that is different for everyone. There is really no hard and fast way to do that.
Yeah, I think one of the beautiful things about algorithmic investing is, especially with this community, is there's such a diverse amount of different theories and philosophies and ways people design, which ultimately, I've kind of been questioning this box. If we do create like a standardized curriculum, that will tend to skew all of the design and philosophy into a singular philosophy, which might ultimately create a failure point.
Yeah, it definitely will.
All right, looking to detect and avoid overfitting. New algo trading, but I've been discretionary futures trader for over 20 years. I was having issues, didn't find any possibility to use company metrics on Composer. I want to do more fundamental algorithmic investing. So I have an entire video on that. Huh?
You can't do it automatically. You have to work in something like FinViz or Wi-Fi or something like that.
Can you share my video with Jesse Greeter on fundamental analysis?
After I pull up all the newsletters I've done on overfitting, yes.
Okay, and then I'll show you.
I'm gathering the resources to answer these questions. Give me a sec.
Okay, I'll show you some tips on how to detect overfitting as well. As a novice investor myself, I am not sure what metrics are good to look at. For example, if high Sharpe ratio is better or current returns. Again, that goes back into philosophy. Different people like different things. I think more importantly is to study the calculation of the Sharpe ratio, like how is Sharpe ratio calculated and what is the downsides of Sharpe ratio. And actually, ironically, using ChatGPT and just having a conversation with ChatGPT is also a really great way to learn about the metrics of algorithmic investing. It's one of the ways that I learned a lot of them is just like, hey, what's the difference between Sharpe ratio and Calmer ratio or Sortino ratio or Trainer ratio? What are the pros and cons of these ratios and why would I use one versus the other? And literally just having a conversation with the AI can help teach you a lot about the downsides and the upsides of each one. My personal favorite metric is actually the Trainer ratio, but they don't have that on Composer.
They do have it in QuantStats, though. So if you use our external tools that we have made as a community, shout out the Raycon, you can look at the Trainer right in there. It's in there. I promise it's in there.
I wish Raycon is in here. Oh, I see somebody else is in here. Glad to see you again. I'm not going to. But yeah, this might be the biggest turnout we've had. But okay, I'm going to share my screen and we're going to rock into this. I'm going to try to keep up with the questions. Feel free to ask questions as time goes on. You can also raise your hand if you want to speak. I would like you to speak so we kind of have a engaged conversation. Man, I am not able to talk today. Okay, so this is a Wikipedia that I have put together. It's still being built, but you guys will get access to it. I'll share it with you here. Actually, we should have done some data collection on that. I need to get the data collection set up so we can figure out what people are going to. But anyways, all right.
Oh my God.
Algorithmic investing, rule-based investing. So this is the fundamentals, the basics of algorithmic investing. So I'm going to skip through this because this isn't really anything important. Let's break down a simple algo. And I'm going to pull up my portfolio. I have two portfolios I've been running. The first one was started basically about 12 months ago. We are going to look at my second portfolio today, which is my active portfolio. So you might see me talk about my portfolios from time to time. I call one the Darwin portfolio. And the theory behind the Darwin portfolio, which was my first one, was basically, I didn't know anything about algorithmic investing. I had theories. I had read a bunch of books. I'd been studying. I have a background of technical analysis and day trading and swing trading, momentum, large caps, small caps, mid caps, penny stocks, low floats. I did a bit of options trading. I've done swing trading, day trading. The only thing I have not done is futures trading. Invested in cryptocurrency. I've basically tried every method under the sun when it comes to investing. And I found Composer with a big background in technical analysis, and I was like, holy shit, I can automate my investments and I can create strategies so that I don't have to do all this stuff manually anymore. And I geeked out on Composer, and then started making a bunch of strategies, got invited into their Slack channel, started posting YouTube videos in their Slack channel. People started liking it. And finally I said, we need to start a Discord community. So we started this Discord community, and now we're here. So the first portfolio was started actually before this Discord existed. And the idea was I was just going to fire off about $3,000 in, I was going to put $50 into different strategies and just see what happens, see what works, and test out theories. And over the past year, I've collected a lot of information, talking with other designers and other architects, as well as my own testing to figure out what works and what does not work. So this portfolio is my active portfolio. This is the Genesis portfolio. This is the one that you see in the newsletter that we post. And these are all actively managed strategies. I actually change them. I tweak them. I do different things with them. This portfolio is my technical live portfolio. The Darwin portfolio is a fire and forget. Like once I put $50 into a strategy, it just goes. I do not touch it. It's purely there to basically collect data and see what works and what doesn't. So let's start with a very simple one. Do I not have? Where's Hello World? Okay. So is there anybody, put a 1 in chat if you are brand new to algorithmic investing and you don't know anything about technical analysis. You kind of know a little bit, but not a whole lot. Okay, so we got a few people in here that don't know
what a chart is, but you don't know how to read it.
Yeah, okay. Let me pull up TradingView, and I will show you the basics of algorithmic investing. And this is also in the thing here. So first off, I have found, and I think that some other architects have found, that there's a standard structure that every algorithm kind of follows, at least when it comes to momentum. So I'm going to pull up my algo board. Actually, let's go to my. Actually, you know what? I'm gonna test run. So this is a script I'm writing for a new YouTube video, but I might as well just run through it here. Okay.
Oh boy.
So this is, yeah. I'm just gonna run through this, and you guys can ask questions on this. So. Biorect, this is one of the longest strategies I've been running. I put $50 into it back in September of last year. It's up $131. That's 163% return in 339 days. That's 171% a year, or about 14% a month. However, this is Andromeda. This is a strategy that I put $50 into back in October as well last year. It's down $13, which is a minus 77% return over 355 days. That's 87% loss a year. So depending on what strategies you put your money into, you can do really well in algorithmic investing, or you can do really bad. So the goal here is to kind of educate you on where you should be putting your money and not be putting your money. This is the part where I say I'm not a financial advisor and I can't tell you what to do with your money, yada, yada, yada. But be smart with your money. So what we're going to cover here is how algorithmic investing works. I'm going to talk a little bit about evolutionary testing of portfolios, the Darwin portfolio, which is what you can see here. I think I can zoom in on this actually. No, I can't.
You got to make that full screen when you do this live. Or
do what?
When you finalize this, that has to be full screen. That's completely unreadable.
It's not really meant to be readable, though. And then lastly, we're going to be talking about the actively managed portfolio, which is my Genesis portfolio, which I was just showing you. So a little bit about me, I already kind of went through the background. I started day trading 6 years ago, made a video how I learned to day trade in a week, got into long-term investing and swing trading and dividend trading and fundamental analysis 3 years ago, made YouTube videos over the years, done it all, yada, 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 cryptocurrency. Found Composer last year, 7 months later. I've done 7,000 back tests, built 506 strategies, done 19 million days of total back testing, and one of the top 1% builders of Composer. So what is algorithmic investing? It's rule-based investing. Standard algo logic. If this happens, do this. If this happens, or if it doesn't do that, do this. So that's the basic. There's typically a momentum switch, like the 200-day moving average on the S&P 500. If we are above the 200-day, we go into a long position. If you are in a bear market or you're below the 200-day, you go into a hedge position or a sort strategy. So this is a very simple algo. If we are above the S&P 500 on the 200-day, we're going to buy SPY. Actually, I think I walked through this. So momentum switch. If the S&P 500 is above the 200-day moving average of the SPY, which is the yellow line here on this chart, which you can see colored in green. So when the background is green, we are above. When the background is red, we are below the 200-day, which is the yellow line. We are going into a long position and buying the SPY. So green, we're buying SPY. If we are below, we're going into the next part of the logic, which is a mean reversion. So the 10-day RSI of QQQ is less than 30. Mean reversion is a theory of algorithmic investing where you're essentially looking at the algo or the asset that you're investing in as a signal, and it oscillates. It goes back and forth in a wave pattern. But there is a average, like there's a line that you can draw through the mean or the average, which is the mean reversion. So whenever you see mean reversion in algorithmic investing, what it's referring to is essentially a strategy that arbitrages the oscillations of the standard line that the strategy is moving forward. I hope that makes sense. I need to write that. I need to make that simpler or explain that better. Box, can you think of a simpler way to explain mean reversion?
You're basically... So when you see a trend going in a direction and then something suddenly goes against that trend, mean reversion investing is basically betting that it will return to that trend.
Yep. Yeah, much better said. Okay. So, can I open this up? Is this going to show? Let's go to QQQ, and I'll show you. I've got an indicator I use for the RSI as well. We're going to go to the daily chart real quick, and I'm going to add my RSI signal analysis. Now, I'm going to get rid of the volume. We'll add the RSI. So you can see here, this is the 10-day RSI of QQQ. And these white lines and black lines are, let's just do the black lines or the white lines. We don't need white line. So every time you see a white line here, the RSI of the QQQ has hit 30. So you can see down here at the bottom of the chart, every time we tick below 30, these white lines were triggering this part of the algo. So if the 10-day RSI of QQQ is less than, we're going to go into this. So let me go back into my presentation mode. So if it's not below, let's see. So if it is below the 30-day, we're buying XLK. Now, XLK is the technology sector of the U.S. stock market. Technology is usually very heavily correlated to the overall stock market. So if the overall stock market is very oversold, which is what happens when we are below the 30, like this is basically indicating that we're very oversold, we're going to buy technology temporarily to capture a little bit of profit or arbitrage off of the mean reversion, because there's a very high chance are very high probability that the technology sector is going to bounce back and we're going to make profit on the upside of that movement. So that's mean reversion, essentially. Now, when the QQQ is above 30, so in these areas here, when we're just in normal market positions, but we're in a bear market here, we're under the 200-day. So we're under the 200-day and we're in a normal bear market strategy. We're going to buy XLP. So XLP is consumer staples. Consumer staples are companies that usually weather recessions very well. If you're brand new to investing, consumer staples are companies like CVS, Costco's. You could even argue that McDonald's is recessionary because it's McDonald's, like Coca-Cola. Any women's beauty products are also very good at weathering bear markets because women buy makeup no matter what the economy's doing.
Accurate.
Ironically, kind of funnily, but XLP, consumer staples, they're very defensive companies. They're companies that usually weather bear markets very well. So we're essentially going into a defensive position during normal bear market conditions. So that's the basics of algo. You typically have a large macro switch, like the 200-day, which is the yellow line here. And then you have some form of usually mean reversion or momentum strategies. But basically, all algos follow this basic structure. They can get more advanced or less advanced, but that is the fundamentals of an algo. So do you guys have any questions on that so far? Anything that I've covered so far with this? And then lastly, I will run this exact strategy. So this is the strategy that I'm showing you. I'll share this with you guys. You can have it as basically the basics, but you can see this is, whoever asked, how do you spot overfitting? I'll kind of show you some strategies or things that you can do right now to spot overfitting.
You want me to send you the link to the exact chart that you can pull up?
For what?
To show how to look at a chart and just know that something is overfit?
Oh, yeah, shoot me Andromeda or one of them. Might take a minute to load.
I don't have a link to Andromeda. I have never followed it. I was actually going to send you a link to one of the cheetah versions that got made.
Yeah, you can send me any of them. Okay, so one of the ways that you can test for overfitting is essentially scrub fitting, or like doing a 1-year scrub. So a lot of times people will design a strategy off of just one date time, and it might look really great at that one point, but you can actually reduce it down to 1 year and then just scrub through and see if there's time periods when it really doesn't work well, or it's
I actually recommend going below a year, like 6 months at maximum, because the main thing that you want to get a view of is how often do you severely underperform the market, even though the end outcome is outperforming it.
Because most people, we've actually seen this in the community a lot. They'll put money into an algo that looks great on a 10-year back test, but for the first 3 months it just bombs, like it's down 30%, and then people freak out and they're like, "Oh, this algo doesn't work." But it's like you're investing in an algo that was designed around a 10-year window, but you're freaking out in 3 months. Like one of the best things about doing the 3-month scrub or the 6-month scrub is we can see that this algo, Hello World, was actually down 5% over this 3 or 4 month window here. If we started it in December of last year, and I'm sure we can find other periods where it vastly underperformed for a short period of time. Let's see. It's actually pretty stable, but this is also because it's simple. So this algo is very simple, so it's hard to break something that's so simple. Yeah, it's actually pretty decent. But I'm going to run this back to 1999, which is the farthest back you can run it. And you can see that this strategy alone, if you had started it in 1997, did 1,600% versus the S&P 500's 422%. Now, this is also the part where you say, past back tests are not indicative of future returns. The past 20 years of the stock market is not going to repeat. It's not guaranteed. And I think a good standard for back testing, typically, I don't know, Deeds, what have you found? I think if a back test comes out with like 100% returns year over year, realistically, it might perform 30 to 50%.
No, that's not how overfitting works, unfortunately. So the thing about overfitting is once you have determined that a strategy is very likely overfit, you can't trust anything about its back test anymore.
True.
Like it doesn't matter that the AR comes out at 100% AR. If it's overfit, that means that it is not able to actually predict anything in the future, which means that it's not going to work as it might get like 20 or 30% of what it says it gets. It might inverse it and you might have a negative 99 AR and you just have no money in 2 years. Like it becomes completely useless for the task of predicting anything in the future.
Yeah, but
this is why everyone calls me the overfit police, because like I don't let things like this happen.
Yeah, but it also depends on the complexity of the algo. Like this algo specifically, because it's so simple, it's kind of impossible to say it's overfit because there's literally nothing to it. But there is a period here. Look, this is actually down 10% for, if you had started this in November of 2000, you would have been down 10% for 3 or 4 months.
Sure. But that doesn't mean that it's overfit. That just means that it didn't beat SPY at that time.
Yeah,
which is perfectly normal for like a functional strategy is going to lose to SPY at some point in time.
Yeah.
At least on Composer. At least on Composer, given that you can only trade stocks and ETFs once a day, you are going to lose to SPY at some point.
Yeah. And let me show you, this is probably a better example. So this is BioRect. This is a bit more of an advanced strategy. And another who's hot micing?
Great question.
Can you get them muted?
I think so.
Okay. So another way to a very quick and dirty, like not super efficient way to measure if something's overfit or underfit. There tends to be a kind of a sweet spot of how big an algo is to be successful. Now, this is an individual branch too, and I should clarify too that there's been evolutions of strategies. So you can kind of break the. There's been 3 kind of major shifts in algorithmic investing inside this community for the past year. So the first versions of algos being built with Composer back was last year, around the time the Discord was starting. And the first versions of the strategies were very simple. They were just basically like rebalancers. If you're familiar with M1 Finance and how they do their rebalancing, it was nothing super complicated. But then the Discord community started, and we had basically an explosion of creativity and an explosion of more advanced strategies and algorithms. And there was different like kind of evolutions. But most of the strategies built between the start of this Discord and maybe about 2 months ago were essentially just single algos. So this is a single algo that we're looking at. It's BioRect. And this is kind of a sweet spot of like the size of a good strategy. Anything more than this can tend to get overfit, and anything less than this will have more simplicity, but you might not get crazy returns. Like this is the one that's done 150% returns or so over the past 350 days. But you can just kind of see this and scroll that this is about a sweet spot in size of a design of an algo. Now, with that,
just to add some detail, when you say size, what you actually mean is depth. Like each individual branch doesn't have 10 or 15 different sub branches that get increasingly more and more specific about what they're targeting.
Yep.
It's relatively to other strategies very broad in what it's targeting. It doesn't ever get down to a point. Is BioRect one that focuses on holding one thing at a time, or does it hold multiple things at a time? I don't remember.
No, it's just a singular. It's a single hold at one time. Yeah. Well, I take that back. The bullish side of the strategy does have a better QQQ, which is the top companies here.
Got it.
Probably should change. I wonder if that weighted and market cap would do better. But a lot of also you'll see certain strategies nested and copied into different strategies as well. For example, a better QQQ is something you'll see in quite a few strategies. And then there's better by the dip NASDAQ. But this is actually BioRect as a whole. But then it has, like, this is the actual full strategy. It just has a bull market strategy nested into it, which is the better by the dip NASDAQ. So yeah, this is kind of the sweet spot of strategy. So is there any questions so far on any of this stuff? Anything that I've missed or haven't answered yet?
Before you get off the topic of overfitness, scroll all the way down in chat and open the link up.
In chat? Yep. This one? Oh,
now open the strategy up.
Now let me show you an overfit strategy. How has Cheetah done?
Terribly, god awfully. But so what we're about to show you is one of the fastest and simplest ways to tell if a strategy is overfit. The only downside is that it requires time. It's not something that you can just do the same day that you make it. So, what is the last day in this back test? Give me 1 second. I got to figure out when. So set the back test to July 1st. Jesus. I forgot how long this is.
I don't have the button to open it up.
That's fine. You don't even need to open it. It's not. It has nothing to do with the logic of the strategy at all.
All right.
July 1st, 2022.
2022?
Yep. So red flag 1, the back test is not even a year. Red flag number 2 is, do you not have the out of sample line on this?
Yes, it is, Bear. We have the out of. I think you don't see the out of sample in the edit, but you do see it in the view.
Oh, okay. So
let me reopen it.
Yeah.
Takes a minute.
Left-handed bears, yes. It is an example of multiple things, but overly complex is the very simple way to explain it. Yeah. It basically takes multiple strategies that themselves are also overfit and just crams them all together. The reason that I pull this one up is because it's the clearest example that I've found. So if you look at the of the performance before the out of sample date and after out of sample date, they're completely different. Like nothing about one is even similar to the other. So out of sample, depending on how new you are, out of sample is basically 1/2 of in sample versus out of sample. In sample is things that the strategy or algorithm is trained on. Out of sample is new information. For the purposes of Composer, if you are not somebody who knows how to code in things like Quant Connect or Quant Stats or building your own things in Python and stuff like that, it's very hard to specify your training data. So live running in Composer is the fastest, easiest, and in my opinion, because I can't code either, the only way, because I just don't know how to do it. But one of the very simple things that you can look for is similarity in how it works in and out of sample. You can see that you have a very steep line going up into the out of sample data, and then it just does nothing but go down once it is live. So, boom, overfit.
Yep. So a good rule of thumb, number one, when you come into the community, you want to leverage the people that are the best at what they're doing. So you need to find the people, the master architects, the people that know how to build strategies, have successful portfolios, are performing. Start talking to those people, learning from them, asking them questions. Hey, what are you running? Why are you running this? That's the best way to learn, is interacting with other people. Then it's if you don't know a strategy, if you're not familiar with it, if you don't know how it's designed or why it's working, you need to follow it for about 3 months. Just throw it in the watch button here and just watch what happens. And also pay attention to the out of sample. Obviously, this one's been running for a while. It clearly isn't performing. Probably not one that you want to throw money into. This out of sample line is very important. If somebody launches a new strategy and it's only been running out of sample for a couple weeks, use at your own risk. It's really up to you. But you should usually standard practice, follow it for 3 months, watch it, make sure that it's performing and understanding why it's performing well. And then from there, you can scale in.
But I just want to expand on that, because that is one of the most important parts about this. Understanding why it is doing what it's doing. One of the things that I constantly tell people, constantly say in newsletters, is if you do not have a thesis, if you do not have a strategy, if you don't have a plan, you are just gambling. You have just automated your gambling.
Yeah.
That's it. You don't have a strategy. You don't have anything. You're just slamming assets around, hoping that it goes up the next day. That's it. So you need to be able to explain why your strategy does the things that it does at the times that it does them. And if you can't explain that, if you can't explain why your logic gates are what they are, what past historical basis for those decisions, then you are not trading, you're not investing, you are not strategizing, you are just gambling. That's actually my first recommendation for avoiding overfitting, is if you can't look at a strategy and tell why it is doing what it's doing, it's overfit, just right off the bat. If there is no plan, overfit. Throw it away, don't even look at it.
Yep. So, Josh, that's a really good question. Not to sound negative, but in my experience, you're looking for an edge that is understandable, simple, and quantifiable, and you can test for it in the data. Then you can build a back test to test your hypothesis. Most of what I've seen is hindsight biased, like short volume is doing great this year, or high leverage short volume. Yeah, high leverage ETFs and sectors that have done well past X months. Seems like there is not an edge, but simply complex overfitting, not in all of them, but we would love to hear the reasons and rationale for the actual edge versus alpha versus a bunch of back tests. So that goes back to, it depends on the architect. It depends on the philosophy and the experience of who's building the strategy. Everyone builds differently. Some people have a lot of background and experience and knowledge in bonds. Other people have a lot of equities or commodities. And it just depends on that individual's background. I can tell you, I personally like to build off larger macro cycles, because I understand that even if I can get a 20% a year return, that's insane. Like, that's an insane amount of returns over a decade. If you can get 30 or 40%, it's very hard to screw up becoming wealthy with that amount of returns. Now, my personal philosophy is I imagine I would like to have 10,000 algos that are basically on a switchboard, and then whichever ones are performing well over a given time frame or a given metric, like measuring by Sharpe ratio or RSI or cumulative returns over like a 10-day window, 60-day window, 100-day window, figuring out which ones work well, or which metrics are the ones to be used as the on and off switch. I would like to basically just dynamically turn on the strategies that are currently performing well and turn off the ones that are performing bad. Everything that I've studied, reading books, studying other algorithmic investors, there's a really great book called Unknown Market Wizards that I highly recommend everyone. I'll give you guys my top recommended books that you guys should read for algorithmic investing. Unknown Market Wizards by Jack Swagger. Chapter 8, there's a algorithmic investor that averaged 20% a year for 20 years. He interviews him and he gives some really great insight on how to do algorithmic investing right and how to do it wrong. One of the biggest takeaways from that book was it is better to have 1,000 simple algos than one algo that's highly complex or has a lot of moving parts. And if you think about it, if you think about the stock market and equities and assets and their price charts, you're really just measuring a wavelength. It's really just a wave. So the goal is if you can have 10,000 algos that are all dynamically turning off and on, eventually, if you can get enough of them, the equity curve just blends. The idea is to just have an extremely smooth equity curve because you have, like a couple thousand algos currently online, currently trading. And because there's so many of them, you actually decrease your risk of failure because you have so many running. And you also have a very wide, diverse evolution or robustness to your portfolio. At least that's my personal philosophy. Not everybody agrees with that. There are people in the community that invest differently. There's other people that love to just hyper focus. They just want whatever the one best algo is right now. But it all comes with its own risks. Another great book to read is Market Sense and Nonsense. This is a book that actually ran a bunch of tests of algorithmic strategies or backtesting strategies, comparing strategies from hedge funds versus mutual funds and algorithmic funds over back to the 1970s. Really interesting read with a bunch of information on what works and what doesn't. But okay, so that's overfitting, and that's kind of the answer to that. Does that answer your question, Josh? Would you like me to elaborate on anything specifically?
I would actually like to add something to that, if we have a moment.
Go ahead.
So this is actually why I always recommend having a theory and a thesis before you even start building the strategy. The best possible example, and in my opinion, the only good strategy that I've ever built is Pareto's portfolio, based off the mathematical principle that 80% of results in any given anything comes from the top 20% of performers. So when you take that and apply it to the stock market and you apply it to indices, it comes out roughly being very true, relatively speaking. The majority of movement at any given time in the stock market, up or down, so it's a knife that cuts both ways, up or down comes from the top 20% of things in any given index. So if you want to just click on that link and open the strategy up real quick, Aaron, it's very simple. It's one of those ones that looks very big because there's very large baskets involved, but the logic itself is basically non-existent. It's just a bunch of rotators that take the top couple things out of any given index. So we got the SPY, you got the NASDAQ, you got the Dow Jones, and then you have commodities and bonds, and that's it. And the only logic is deciding whether or not interest rates are rising or falling.
Yeah.
And that's it. And that's the only logic in it. Everything else is just pick the top things out of indexes and let it ride.
Yeah. Yeah. When it comes, go ahead, continue. If you got more.
It's very unlikely to ever hit 100% a year. It's honestly very unlikely to ever hit 50% a year annualized. But the logic is that the big things are the slowest to fall, they're the fastest to go up, and there's always something, except in black swan situations, there's always something that's going up, whether it's commodities, bonds, or stocks.
I got to take a phone call real quick. Can you keep going, Box?
Jeez, sure. Okay. Yeah, so I guess now would be a good time. Josh, does that answer the question, perhaps? I guess the argument of edge / alpha versus just a bunch of backtests is I hate the backtest. If Composer was to listen to me, they wouldn't show people the backtest at all. I think 90% of people probably in this call, 90% of the people that use Composer don't actually know how to read a backtest. It's very easy to trick yourself. It's very easy to lie to yourself with a backtest, which is exactly what the chart for Amoeba does, because it shows you a near parabolic chart up until the day that it goes out of sample, and then it all just falls apart. I don't really look at the backtests at all until I'm completely done building the strategy. Love to understand the edge / alpha people are trying to exploit. Yeah, it would be helpful to document that. So specifically for Biorect or any of the TQQQ strategies, we do have a couple calls with Derek that Derek's actually done that explain his thought process, the thesis behind everything, the academic papers that he's based his decisions off of. There is a lot of thought and research that has gone into specifically the TQQQ FTLT strategies. At the very least, we have probably 5 or 6 hours worth of video between Garen and Derek, Garen on his own, Derek on his own, interviews going over the exact edge for those strategies. As far as other strategies go, I can't promise there is an edge. I can't promise there is an alpha. I can't promise it is anything other than just pretty lines on a test, which is why I don't really recommend a whole lot of strategies unless I've built it myself, because not everything has a theory behind it. And if it doesn't have a theory, you don't have a strategy. You're just gambling, like I said.
Yeah, that's... You want me to take back over? Yeah, that's one of the things that's been kind of rough with Composer, Josh. We've actually requested them to have like a place to put notes on the strategies, like writing out like what this is and stuff. But currently there's no good way to document the theses. It's really just being integrated into the community, talking with the builders, watching the videos that I've recorded with the people that I've interviewed. If you're trying to build strategies, here is where I would recommend you find the alpha. So from what we've seen, there's everyone that gets into algorithmic investing focuses on high frequency trading. They focus on intraday. They focus on minutes, 5 minutes, 15 minutes, daily stuff. So it's hyper competitive in that realm. This actually is a business philosophy more than an investing philosophy, but oftentimes the most profits are found where nobody's looking. Like getting into the really boring investments, the things that are nobody look like. If you invest in something that's on the headlines, you're almost guaranteed to lose money because you're investing in the hype train. And by the time everybody knows about it, it's probably all the profits are gone. .com bubble, crypto bubble, like 3D printing bubble. Yeah.
Electric vehicles in 2020.
Yeah, I have found, and I've seen, or at least I also theorize that there is a tremendous amount of profits in the slower time frames. If you design strategies that are yearly, multi-year, 3 years, if you do fundamental analysis, because not a lot of people know how to do fundamental analysis, and if you use basic fundamental analysis, which I have a YouTube video on doing fundamental analysis with a professional private equity investor, one of my friends, Jesse Greeter, he built a $0 to $30 million private equity firm from scratch, and he has I don't know if it's a master's or what, but in fundamental analysis, he literally crunches numbers and builds his own calculators to buy companies himself in private equity, and he's also done public equity strategies and investments as well. But I sit down with him for an hour and we go over the very basics of fundamental analysis. But finding alpha in fundamental analysis in the long-term, multi-year momentum strategies, understanding how bonds influences the world, like what we were just showing in this strategy that we're showcasing here, building strategies that work around bonds or work around volatility, and then arbitraging equities. There is a direct relationship between bonds moving and then something happening in equities. You can find alpha there as well. Also, the 30-year stocks to commodity curve as well. Let me show that to you real quick. So this is what I personally like to design off of. Let me get rid of.
Oh, also about the notes thing, you can, if you actually have a strategy, you can just put it in the description box. It's not great because like it takes up a whole bunch of space on the screen and it gets really hard to read it on mobile, but it's possible. It's not great, but it works.
People should probably link. They should probably link their Discord, the Discord thread inside the strategy. I think that would probably be useful.
Yeah.
Okay, let me add PPICO. Wait.
Also, Josh, if you're looking for another strategy that has actual thesis and theory behind it, go look up the Dragon portfolios that Sandy made. One, we have an entire interview video going over the V2 of it, but he's up to about V5 now. And if you're familiar with Artemis Capital at all, it's okay, so you already know. It's like it's basically an implementation of Artemis Capital's Dragon portfolio, which is kind of the basis for a bunch of other things that, like the cockroach and everything, it's very similar in a lot of ways. But they've got more research and more data on how their investment strategy works and the thesis and everything behind it than a lot of the strategies that get posted in the server. Also, something that I want to be on record for this video is if you go to the Algo database, there's about 1,750 strategies in the Algo database. And I will be very open about the fact that 1,700 of those are probably dog shit. And you just shouldn't invest in most of them.
Here's another potential place for arbitrage or alpha. The relationship between commodities and equities on a 30-year time frame. Obviously, this is like a very long thesis to test, but there's a direct relationship between inflation, the Federal Reserve printing money, and inflation or interest rates, and commodities and equities. So let's start with this simple chart. This is stocks to commodities ratio chart, 150-year chart or 120 years. I'll post this here. This is essentially the S&P 500 weighted in commodities. So like what happens, which is better to invest in, commodities or equities. So during the 1800s to World War I, equities had a bull run. Then World War II breaks out. They start printing money. Inflation rises to pay for the war. Equities tank in relationship to commodities. So commodities were a much better investment during this period. Raw resources, whenever conflict rises, whenever there's tension, world issues, prices rise on commodities because it constrains supply chains and stuff like that. We're seeing a very similar trend right now with China and America heating up. Then after World War II, we have the roaring 20s, the deflationary period. We have a massive boom in the stock market, then the collapse and the Great Depression. Then we have World War II breakout, and we just have basically 20-year sideways movement up in the 1950s. War ends, deflation starts, and we have a bull run through the 1950s. Then we have the gold crisis and the Nixon axing the gold standard in the 1970s. And then we have high inflationary periods where like interest rates hit 18%, huge deflationary period where commodities absolutely demolished the equities. And then through the 1980s and 90s, we had the huge bull run. We had 9/11 and the Iraq wars and the housing market crash, and commodities absolutely demolished equities as well. And then we had this huge bull run over the past 10-year period. But you can actually see this in the stock charts. So this is the S&P 500. This is the Great Depression, World War II. Then we have the bull run. But if you analyze just this, while the stock market's going sideways, there's a huge bull run in commodities through after the Great Depression and World War II. As war breaks out, we have a huge bull run here. And same for World War I. This is World War I, huge bull run in commodities, and then it ends and we have the bull run in the 1920s for equities. Now, moving forward, commodities flatlines through the 1950s and the 1970s through this bull market in equities. Then we have the gas or the Nixon axing the gold standard and the gas crisis and commodities absolutely just rips and runs up into the 1980s. And then commodities flatlines and you have a huge bull run in equities. Then 9/11 happens. You have the Iraq war breakout, Afghanistan war breakout. We go sideways for 12 years through the stock market while commodities have a huge bull run. And now it does take a hit through the housing market crash, but they continue to rise. And then we finally have a breakout while commodities kind of go sideways, but commodities are currently going up through inflation on COVID. So with that idea, there's also a lot of room to arbitrage this large macro movement. And I think my personal thesis is you could easily get a 20% APY over a 40-year time span playing essentially these large macro movements. So that's one other theory to test. But yeah, so anybody have questions so far on anything? Is there anything that you guys would like me to walk through, show you? Like anything, ask any questions. Any problems you guys are currently facing? Is there a better back test? What do you mean, Narwhal? Like better back test?
Because he was talking about how, like, while you were on the phone, I was basically explaining to people that I think back tests are just highly misleading in general. And that, but like the answer to that question isn't necessarily that the back test itself is bad or wrong. You could make an argument that because you trade at 350 and the back tests at 4 o'clock, that it's a quote unquote bad back test because it's not 100% accurate to reality, but that's an entirely separate argument to get into. My point is not so much that the back test on Composer is bad or wrong. It's that most people just don't know how to read them. They see a line going up and they assume that it's going to continue going up like that. They see an AR of 100% a year and they assume that every year they're going to get 100%. The fix for things like that is realistically doing what Garen said in the beginning and doing like the timeline scrub where you shrink the view window down to 1 to 3 months and then you scroll through it. And then you just need to mentally take a note of, okay, how many months is it down 5%? How many months is it down 10%, 20, 30, whatever your max drawdown is? Like how many times does it do something that is not quite that maximum but is still bad? And then you basically need to mentally prepare yourself for that. Because like Aaron said, one of the biggest problems that we see is people come in, they see a strategy that has a max, 20% down drawdown, let's say. And they see that it's down to 10%, down 10% in the past month, and don't expect to go down anymore. And then it goes down to 15 and then they freak out and they sell out of it or they withdraw a whole bunch of money from it and then they basically lock in their losses. because they never went through the back test and really isolated how often it is that it's going to be that they are down some significant amount to SPY. Which is why when people come in and they ask for like strategy recommendations, the last time somebody came in, my 3 questions was one, do you want to be like Michael Burry or do you want to be like Warren Buffett? Do you want to make one incredibly risky trade and risk losing everything? Or do you just want to get rich slowly? How easily can you handle 1% down, 5%, 10, 25, 50?
Yep.
And finally, how often do you actually want to be checking Composer? Because once you have those questions answered, you can kind of start to get an idea of what your actual risk tolerance is and go from there. But yeah.
So I'm going to share with you guys some work that I'm currently doing on some research. So Composer has recently released the ability or the feature to nest algos inside of sort functions. So earlier I was saying there's been basically 3 evolutions of algos in Composer and in this community over the years. The first one was pre-Discord community, which are basically just simple rebalancers. Then the Discord community came out and we started building really advanced dynamic mean reversion strategies and momentum strategies. And then there's also nested rebalancers. That's like a version or a type of strategy, like Sandy Dragon's Dragon portfolio, any kind of portfolio that has like a large diversity with rebalancers. That is a type of algo. So on one hand, you have like a Sandy Dragon rebalancer, and then on the other hand, you have a hyper-focused strategy like BioRect, which is only trading one asset. Those are the 2 types of strategies in the version 2 algos of Composer. But we're now entering into a new era of version 3 algos, which is dynamically sorting algos. So this is the research that I'm doing currently on my portfolio. This is my Genesis portfolio, the paid newsletter. This is a strategy called Let the Data Speak, which I have been watching. I launched all of these on August 21st, which was almost a month ago. This Let the Data Speak is currently up 8%, and this is just the static original algo. So Let the Data Speak was built, I don't know who built it, but it's been around for a while, and it's performed pretty well. It's pretty
sure it was Derek.
Okay, it was Derek. So it's more like, it's definitely larger than the standard algo, but because it was built by Derek, like he knows what he's doing. And it looks like it's not terribly complex. It looks like it just has a bunch of it has just a lot of baskets in it, which is making it look larger. The actual depth of the logic isn't crazy deep. But what I did was I took this static version of Let the Data Speak and I made some dynamic allocations to it. This one is currently up 32% in less than a month on the watch list. So if we open this up, you can see in the back test, this was the original Let the Data Speak, and then this is the dynamic rebalancing. So how this works is now we can actually nest these algos, and I'll show you the original one so you can see. Where's the... All right, so this is the original one. So this is the original strategy, and what I did was basically take it and put it into a dynamic rebalancing, and I've been testing out different metrics. I don't know if standard deviation of returns or RSI or cumulative returns or moving average returns. I don't know which metrics work the best for this, but I'm testing them out currently to find out. But so far, standard deviation of returns is working really well. And I also went inside of the individual algos and I started doing dynamic nesting or dynamic rotations inside of here as well. So this is essentially the third evolution or the third version of algos that are coming out into the community right now. So being able to turn this one basically selects the top one of the highest standard deviation. So it's essentially selecting which one is performing. Well, actually, it's not That's not accurate. It's not selecting the best performing one, because standard deviation is only it only measures, it doesn't measure up or down momentum. It just measures momentum, which is unfortunate. So for those that don't know, standard deviation is essentially like a measurement of how do you explain standard deviation simply? Yeah, this one is not launched publicly yet. VBZ. It's in my premium portfolio. I'm testing out stuff with it right now. Yeah, it hasn't been shared publicly yet.
Like
Yeah,
even the original things that it's built off of. I don't think Derek's ever shared any of it publicly.
Okay. Yeah. I think that's probably why I didn't share it. Anytime somebody sends me something and they tell me not to share it, I don't share it. But you can see that this is the original Let the Data Speak, and then this is the dynamic version, at least on the back test. And it's been performing well live as well, which is kind of shocking. 30% in a month is quite insane. So this is the next level.
And then we'll see.
Yeah, this is the next level of algos too. So for you guys that are building algos, one of the benefits, if you have a current portfolio, you can start taking like your best strategies and throwing them into a dynamic sorting function like this, and it will start to just turn on whatever algo is actually performing the best. Now, there's a risk that you need to know on standard deviation, and that is, yeah, that's a good way to put it. But like as far as, so let me put it to you this way. Actually, I can show it to you. Let's just graph it, because I think it'll be easier to visualize it. Standard deviation. Okay. So this is standard deviation. Let's go to a daily chart. Do a 30-day look back and a white line. Okay. So unfortunately, standard deviation will proc whether the stock market is going up or whether the asset is going up or down. So ideally, we want a standard deviation and the strategy is bullish, like it's moving up. Currently, the one risk of this is this just measures whichever one is essentially the most aggressive, whichever one is like the most out of its standard movement. Now we want that to be like the most profitable. So if you imagine, let me just take a screenshot of this. So these are the three strategies that we're sorting from. And if I paste this here, you can imagine that every single one of these strategies essentially has its own like equity curve, like its own return. And what the 30-day standard deviation is doing is selecting whichever one has the most aggressive standard deviation. Unfortunately, it doesn't measure if it's bearish. So if the bearish movement, if one of these algos becomes extremely bearish, it might actually turn that one on, because standard deviation does not measure bullishness or bearishness. It only measures the maximum deviation, or whichever one is the most out of its normal range of motion. So this is also why I haven't released these tests yet, because this is a risk that I see here. So yeah. I was thinking of actually.
So that's one thing I did want to note, is that the strategy that you are seeing right now is something that I would consider extremely experimental.
Yes.
To go try and recreate this from its constituent pieces, don't put money in it, or at least not a lot, please.
Yeah.
Because this is not being shown as an example of something that works and a way to do something. Like Garen's basically walking you through like the thought process behind designing a strategy, not saying that this strategy is complete.
Yes.
Yet.
Yeah. You're basically seeing like the black box stuff right now. This is stuff that I don't share, because it's dangerous to launch this stuff prematurely.
Because one of the theories inside the mind.
Yeah, one of the things that I'm working on, or this is one of I haven't had time to do it yet, but I'll show you the potential fix to this. Which actually, screw it, I'll show you guys. This is how I test stuff. So let's do version 2. Let's do V2. We're going to save this, and this is essentially how I test strategies. So I'm going to do another filter, and now what I want to do is I'm actually going to nest this. So cumulative returns. Let's do a 60-day window of, no, should I do cumulative returns or moving average returns? I wish I could graph the standard. I wish I could graph the RSI or something, because I really don't know.
Well, what's the theoretical basis for it?
Well, I'm essentially going to nest the nests inside of here. So.
No, I get what you're saying, but like.
So now what we're doing is we're selecting. I'm going to basically copy this and make a bunch of evolutions of it, and we are going to select whichever one performs the best. So we'll do a 15-day standard deviation. Let's do a cumulative returns of 30 days. And I have no idea what's going to perform the best.
It still says 10.
Do what?
It still says 10. You didn't hit enter.
Yeah, 10-day cumulative returns, 30-day standard deviation, 15-day standard deviation.
But you said 30.
Oh, did I?
Yeah.
Okay. And this is how I test different algos. Cumulative returns.
Just like this. He's actually not wrong with me chirping in his ear about things that he's doing wrong. This is 100% accurate. Yep.
Okay, so save. Now we're going to watch it. And I'm also going to change this tag to dynamic 002. So this is going to be the second. I'm using tags to batch my testing. So I usually fire off a bunch of tests in batches so that I can keep track of the batches. And I kind of have a thesis or a theory that I want to test per batch. The tag feature is new. So now we're going to make a copy. I'm going to open up a new one. And this is going to be version 2.1. And we're going to change this to cumulative returns of 14 days. Save. Make a copy. Open it. And for some reason, when you open it, you have to refresh it now. I don't know why Composer lags out or something. Version 2. And we're going to we've been doing cumulative returns. Let's do RSI. No, we already did RSI. Let's do moving average returns. Do 30-day. And I have absolutely no idea what is going to perform well. That's why we're doing these tests. And actually, I don't think I watched the other one. Let the dead speak. Watch this one. My watch list. And now, over the next month, I will start collecting data and figuring out, okay, this one works better, this one doesn't. And then you kind of start debugging and back figuring, why does this one work better? Okay, this seems to be what's performing and what's firing. Okay. Make another one. We'll do a long look back on cumulative returns. Actually, no, let's do cumulative returns, and let's do like a 60-day. Okay. Do another one. And now we're going to switch up the logic a little bit. I'm going to throw the very simple I think this is the hello world. So this is going to be an anchor. Like this strategy is pretty. Let's look at it's good to have a very a stable baseline, especially on these experimental ones. So I'm pretty confident in this strategy over a 20 or 30 year back test. So I'm going to copy this, and we're actually going to put it in to the dynamic weighting just as a basically a hedge, basically a protection. If everything breaks, like if all of these algos start performing badly for whatever reason, I want it to at least divert. I want it to switch to this very simple algo as a protection, as a hedge, essentially. Does that make sense? Anybody does that not make sense to anybody? So this is going to be version 3. Is that right?
Sounds about right.
Okay. Make another one. And this is very boring. This is very tedious, but it's not as tedious as being a manual day trader or a manual swing trader and managing your portfolios every day. So like once you fire these off, it becomes exponentially less and less work. Okay. Now I'm going to do the same thing inside here, inside each strategy. Anybody have questions?
I think we got one coming.
With the dynamic option now, this basically makes it easier to test all of these these returns, means, averages, rather than having to do the whole mess of algos. Correct. If I'm following you correctly with your question, yeah. So the benefit of this style of algos is you're basically setting it's a layer 2. You're saying, hey, I only want these algos selected based on this criteria. So you're able to turn the algo off and on, essentially. Like that's all we're doing is like this is essentially an on-off switch of whichever one we're selecting. Now there is a way to do dynamic I have a calculator. Is the calculator on the Discord?
Should be. It's the Google sheet that tells you RSI values, right? Or something.
No, remember the calculator, the dynamic the dynamic weighting calculator I built? Let me find it real quick.
No.
Let me see if I can pull it up.
I don't.
It's in one of my Google Drives.
Sorry, I don't remember that.
Database dashboard. Where's that? There it is. Okay, so this is a calculator that I built that allows me to basically. So here's the downside of this current thing. So we are essentially just selecting the top one. So we're selecting one out. We're selecting one basket of these algos, which is then selecting one of these strategies. But let's say I want to have like 70% in the first algo, 20% in the second best algo, and then 10% in the third best algo. So I don't want to just be all or nothing. I want to have a range of positions inside of that strategy. Well, here's what I can do. let's do, so we have 4 strategies, so that's going to be 25%, 25, 25, 25. And then we're going to select the bottom one for the first one, 2 for the second one, and 3 for the third one, and then 0 for that one. So let me show you what this looks like, because it might be a little bit confusing. Let's just start with this one. I'm going to go to New Symphony. I'm going to paste this in here. Okay, so this is the original one. We've got 4 strategies here. I essentially want to have 61% in the first algo, 27% in the second algo, and 11% in the third algo. So if I go here and we just minimize this again. All right, wrong one. This one. Open this up. So we're sorting by top 1. If I paste this and then I set this to top 2, and I paste this one and set it to top 3, now we're going to select the top 3 in this one, the top 2 in this one, and the top 1 in this one, which is going to give me a 61% allocation, 27% allocation in the second one, and an 11% allocation in the third one. So this is a calculator that you guys can also use if you want. But this allows you to basically weight your algos or your individual sorting functions rather than just having a static, select top 1 or select bottom 2 or something like that. You guys have any questions on that? Does that not make sense to anybody? Okay. And I'm going to call this one version 5.
How do you determine the appropriate cumulative days that you sort and prioritize the selection by?
So that's just doing a bunch of research. That's basically the fire and test theory. So I will tell you that I did do, let me show you some research that I did. That was on my Darwin portfolio. Let me go ahead and watch that. And then 1 sec, I'll have to log into my other portfolio. All right, 1 sec. Let me log into my other portfolio. Call.
So the quick answer with no data or explanation is that it depends on the strategy, like the time frame of the strategy and what assets exactly you're working with. Usually my recommendation and what I end up doing is sticking to something equivalent to week-long blocks. So on Composer, it all works off of trading days. So week is 5 days. So I stick to roughly 10 at a minimum, because any lower than that and you start to get too sensitive for a Composer's trading system, and then your backtest and the live trading don't match up in something like 70% of instances. Like you'll hold an asset live that is completely different than what the backtest says that you're supposed to hold. For something like Pareto's portfolio, which is a potentially weekly to monthly strategy, I try and stick with month-long blocks, because you want to grab what's the word, statistically relevant batch of data, the way that something moved 6 months ago is not necessarily going to help you predict exactly how it's going to move today. But at the same time, if your objective is to measure a trend that may have been happening for the last year, that needs to be taken into account when you pick your windows. The very simple answer is keep it to multiples of 5, keep it over 2 weeks, and keep it. I think this is actually something that like Garen has found in his data, but you want to keep it within like 30 or 40% of the trading frequency of the strategy itself. No.
What are you referring to?
How you pick look back windows for your strategies.
So the look back windows, as far as the indicators to use, yeah. So I've done. This is what I'm about to pull up. So
yeah, just for sorting the algorithms returns.
So I have not done enough testing for. You can recreate this. I'll show you what I did this for individual sort functions. Let me just show you. It'll make more sense when. So back like when was this? When did I post these? This is a private forum where I was essentially tracking a bunch of different ones. I posted these back in January, so about over 6 months ago. I essentially took the Jesse Greeter screener, which is this down here. It's just a bunch of, these are fundamentally scanned companies that I found doing fundamental analysis with Jesse Greeter. And I essentially selected the bottom 7, and then I tested 10-day, 20-day, 30-day, 40-day, no, 10-day, 20-day, 30-day, 60-day, 126-day.
Yeah.
And yeah, I think that was it. And then I tested top RSI, bottom RSI, top cumulative returns, bottom cumulative returns, top moving average returns, bottom moving average returns. And then I just let them run, just like I've been showing you. And I think I found, let me see if I can, so I haven't searched this yet with the Jesse Greeter. Yeah. So Jesse Greeter. The top performing, so here's the top performing ones. So let's take a look at these. So the top performing one, it performed really, so here's the thing, certain ones will perform really well during a bull market, but they'll perform worse during a bear market. So like this one is 10-day RSI, top 7. So top 7 works phenomenal during a bull market, but during downturns, it gets absolutely wrecked because you're essentially selecting, if you think about it, if you're selecting the top RSI of a bear market, you're selecting the stocks that have not collapsed the most. So they're going to have the highest potential to collapse because they have the highest RSI. I bet if I could find the bottom RSI, it'll probably be an inverse. So it'll probably perform pretty. Actually, let's see what the next one.
It's not quite an inverse. It's flatter, but it's not an inverse. No, because I had to try and collate all these into one strategy when this first came out. So it's not quite an inverse, but it is much, much flatter because, like he said, the statistical basis of buying the one that's already at the bottom is going to collapse less than one that's already at the top. But you do also have to note that everything in all of these screeners is the industrials sector, I believe. So there is definitely like sector bias towards different things like that. So tech is going to perform differently, especially over the time frame that we're looking at. The top versus the bottom in tech is going to perform differently than the top versus the bottom in industrials or healthcare or consumer defensive As far as
these were the metrics that I was scanning for. Basically, extremely high cash flowing companies with very high ROI and very low debt to equity and very low current debt, or quick ratio. So they were. These are basically super defensive, heavy cash flowing companies. But it looks like 10-day RSI top 7 was the best. Then 20 days the second best. Let's look at the third. The third is, so these were 19%, 19, 18%. Seven 10-day cumulative returns. So 10-day cumulative returns was the third best. Which one is this? Oh, this is a multitude. This is 60-day RSI, 120-day, and 20-day. This one is just kind of a blah, nothing special. The best one is the Russell's 2000 screener. Wow. This one's done really well. This is 65% weighted, 20-day RSI, bottom one, 60-day, bottom one, 126-day, bottom one, and then Safe Haven. I don't even remember what this is. 20-day RSI. This is a hybrid essentially, but either way, it's performed really well. And then the last one, let's do this one is 30-day. Yeah, so it looks like strength RSI 10-day to 30-day is kind of the best, and especially during a bull market. So it's definitely really performs well. It looks like the longer RSIs perform worse during the bear market. So if we compare this one to, let's open them up. So actually, I wish you could compare. NS26 versus NS28. Let's just add all of these. Okay, so here's all of them. They've kind of all moved the same, it looks like, roughly. I think 31. I can't remember which one was the cumulative returns. I think it might have been the 46. No. But that's where I would start. So if you're doing the dynamic sorting with algos, a safe bet is going to be 10-day to 30-day RSI, top 1, top 2, top 3, whatever. Because
always more than top 1. Yeah. Always more than top 1. Never do top 1. And unless you're just like, unless you have some kind of rock solid theory that whatever statistics you're using to measure which one is the top and why it should be the top, unless it's rock solid and you can prove why, it's almost always just going to be overfitting. Just go with a basket, even if it's just 2.
Are you talking about with algos or individual stocks?
Both. It doesn't matter. It applies to both.
See, I don't know if I would agree with that. I don't know if.
All right, present your thesis, sir.
Because with an algo, typically the curve is a little bit. An algo that's designed right is going to continue to move up, and the RSI is always going to be getting pushed upwards. But if it starts to perform bad, it's going to decrease RSI. But then the next best algo that is performing high on the RSI is going to take over. So theoretically, like if you want to concentrate into the best algo, you would just do top one. But there is a risk with it. But I feel like the risk is less with. I would agree with you on individual tickers. I would also. I wish I could test best performing. Actually, no, I can. Let's figure out which algo has performed during this bear market. Yeah, trailing. I just do trailing 1 month. 1 month returns. What has performed the best over the past month? And is it?
Are we even in a bear market anymore? Technically,
is it 3 months? What is? Let me check. Probably should.
When was the golden cross? That was like 2 or 3 months ago.
All right, so these. Let's check when these started performing bad. So they downturned around July 13th. Okay, so where's July 13th? Let's drop a line. Right here, they started down performing bad. So they performed really well through here. They started February or January 25th. It's January 25th. So this is when they performed well, and then they started performing bad through this market. And that's been 48 bars, so rough, just over a month, like 2 months. Interesting. Why is only 3-month chart? I guess they all just performed badly. Except for this one. Let's take a look at this one.
Also, kind of just goes to show that sometimes you're just not going to beat SPY with a properly risk-adjusted strategy. Sometimes it's just not going to happen. SPY is going to win sometimes. It's not about a month. It's not about 3 months or 6. It's about years. At least in terms of portfolio. And then if you start working too hard to make sure that you beat SPY every single month is when you start risking overfitting your strategy.
Huh.
In a sense, Narwhal, yeah. You're not wrong.
What do you say?
SPY is an algorithm.
Yeah.
In a sense, it's a set of rules, and yeah.
Yeah. A better way to look at what you're building is essentially your own ETFs. I think these are just ETFs.
Sure, but you have to measure the performance against something.
None of them really perform that well during the bear market, but during this past month, like they're all downturning, which is fine. You just go into a short strategy, but 10-day, it looks like the 10-day RSI top 7 performed the best out of all of them, even during the downturn.
Except for when it got right towards the bottom.
Let's see, one NS7 is actually the best. Why is it so? Okay, 27 is the best, number 7. So So 27, this one is 20 day. So there's like 10 to 20 day RSI seems to be like a pretty solid one. Yeah. Now, yeah, I would think just doing top one when you're sorting algos would probably be the safest one. However, the profit margins, there's definitely higher profitability. Well, you know what? Let's just fucking test it. Let me go back to my other portfolio. So I have to log in every time.
Top one offers you the most opportunity for return, but it also offers you the most opportunity for downside. In terms of raw percentage drop. Because even on that chart, it still showed the highest percentage drop out of all of them.
Oh my God, fucking, now I can't log into my account. Oh, this is so fucking irritating. They have their stupid ass SMS text messages, and now I'm locked out of my account.
Oh.
Well, I can't show you guys anymore, but yeah. So when I get more time, I'm definitely going to test out top RSI 10-day.
Sure. So this is actually why I like cumulative return better than RSI, because I know how cumulative return is calculated, and I don't know how they calculate the RSI of strategy. I haven't been able to figure out how they calculate it, and if I can't figure out how they calculate it, I don't use it.
Well, I think it's just the same. I would assume they take the cumulative returns and they just use that as the input to the RSI.
Sure, that's a valid assumption, but I can't confirm that you're right or wrong, so I just don't use it.
Is there have they not written out any calculations on there?
I'm gonna be honest, I haven't looked. They might have. I just haven't looked for it.
Okay.
But
well, anyways, you can't plug in an algo directly into another symphony, right? It's just you can show it on a back test, but can't.
What do you mean?
You can't run a symphony inside another symphony, like multiple symphonies.
Yeah, yeah, we do that. We nesting. Yeah, that's like one of the first things that we started doing is plugging algos into different algos to test which ones work the best.
I'm not seeing that option. Yeah.
Well, what do you mean?
Exactly what you're talking about. I don't know. Maybe it's
So the feature that they added most recently that guarantees the ability to add groups inside of sort functions. So the pink boxes, you can basically rank order your strategies by RSI, cumulative returns, I believe standard deviation. Have I made something with that yet? I don't remember if I made something with that yet.
1 sec. I'll be right back.
Okay.
If you guys have any questions, go ahead and ask.
Yes. So there is one from the chat, actually. Raghav. Yeah, sorry, I have no idea how to pronounce your name. But how do we trigger another algo in the downturn to minimize the loss? So there's two different ways you can do it. The classic way to do it, I guess, from Composer launch till about 2 months ago would have been to have some kind of logic that detects that there is a downturn in whatever assets that you are trading. So something like 20-day moving average of SPY has moved below the 200-day moving average or something like that. And then that has a separate logic branch that you trigger. In the new features that they have launched, the ability to put groups inside of sort functions, you can literally just have strategies that have different triggers in them and then tell it to pick whatever strategy it is. The thing is that you can't tell in advance when the strategy is going to start going down, so you can't preemptively exit it before a downturn. You have to wait for the trend to present itself. And that is kind of the biggest takeaway from a lot of things on Composer, is that your ability to predict the future is limited. You basically have to detect trends as they are happening, and it's all about detecting the trend earlier and earlier. So how can we trigger another algo in the downturn to minimize the loss? Have multiple strategies in the basket that are reasonably diversified. So if you have a strategy that trades the S&P 500, have one also in the same basket that trades the Dow, one that trades the NASDAQ, one that trades bonds, one that trades commodities. And I personally much prefer cumulative returns to RSI for these baskets because I can figure out how cumulative returns is calculated. Haven't figured out how they calculated the RSI of a strategy, so like I said before, I don't use that because I don't know how it works. And if I don't know how it works, it's not a strategy. I'm just gambling. But yeah, so the very simple one-word answer is diversification. Put multiple things in the basket, and then it all just works itself out from there, basically.
What was the question?
How can we trigger another algo in the downturn to minimize the loss or exit the strategy? Two-part answer. One, put multiple things in the basket that aren't correlated. And two, put logic in this strategy.
Are you talking about sorting functions?
Nope, we were not talking specifically about sorting functions. It was a very general question.
So you just identify like the part of the algo, like if you're on the bullish side of the macro momentum switch or the bear, like there's usually a macro momentum switch and a micro momentum switch, like a 200-day and a 20-day moving average, or a 400-day and a 50-day moving average. But then you nest. I wish I could show you because I can't log into my Composer account, but nest it inside of that position. I think we're going to be seeing probably a new wave of new algos coming out with this dynamic sorting. So here's what I can show you. I can't log into my account, but I can show you. We can go back to this whiteboard. So mean reversion by the dip NASDAQ. Okay, so this right here. On the mean reversion, we have the hedge, which is XLP, and I probably should have rotated this so it makes more sense logically. And then by the dip, which is XLK. But there's actually mean reversions that are more efficient than other ones. For example, one of the common ones is actually on the Composer website. I don't know if I can see it. I don't know if I can see it without logging in. Can you send me by the dip NASDAQ box?
Yes, 1 second. I gotta find it. I gotta see if I even follow it. Let's go for a watch list. By the dip. Where is it? Should be in Discord somewhere, right?
So Azir, when you nest a strategy, all you're doing is basically just copying the logic. So sometimes you'll open up algos that will have they'll have a group in there, and it'll have like a name, like the better by the dip by me, or a better QQQ. Like it'll have a tag or a name. But then there's a bunch of logic inside of it. That is, there we go, by the dip NASDAQ. But that's how you nest an algo inside of an algo.
Thank you.
Got it. That's yeah. So you have to manually copy and paste the group. I thought you could just pull in and search for an existing symphony you had, and then just add it into the sort. That would be beautiful.
But
that would be awesome. Yes, that would be amazing.
And That'd make life a lot easier.
Yeah, we still have to manually copy and paste them.
I keep asking the team to add that feature.
We've been asking it for months.
Dynamic baskets are like my second biggest wish behind IRA accounts. Because then we could just automate the entire Jesse Greeter screener and not have to have 47 different symphonies for it.
So this is by the dip NASDAQ, and this is a strategy, this is a mean reversion strategy. I think it runs back. How far does it run back? Pretty damn far.
I think the problem with IRAs is that Composer uses Alpaca and they don't offer it.
Yep. Yeah, that's exactly the issue. But they're apparently working with Alpaca on that, or somebody. They don't really tell us a whole lot.
Yeah,
this is the downside to not working for Composer. Like, they don't really tell us anything special. It's very funny because like everyone looks at the names and they see like me as the admin, Garen started the server. There's a whole bunch of master architects and like everyone knows everything at this time, basically. Which is not fun.
Oh, well, quick question. Whoever's interested in the Roth IRA or whatever, like what broker do you have out of curiosity?
Fidelity.
Okay.
Because I can trade options inside my IRAs. It's dangerous, but fun.
That's wild.
Realistically,
Anybody have, like,
I don't. Go ahead.
I was gonna say, anybody have like Vanguard or maybe I think TD Ameritrade possibly offers them too? I don't know.
So I don't think TD Ameritrade exists anymore. I think they're officially Schwab as of like last week.
Oh,
Have they released their API
I
yet?
think.
Yeah, they sent me an email saying that they're switching over to Schwab. They got acquired or something. So
Yeah.
all my accounts are getting rolled over.
Yeah, that process has been in the works for a while now. But like I think as of like last week, people started getting the option to switch over. I don't use either of them, so I don't have any first-hand experience on it. But from like YouTube and live streams and stuff, that's the information that I have on that so far. But like when I say I trade options in my IRA, I don't do like degenerate zero DTA gambling anymore. I used to. I do that in Robinhood now. But like selling cash secured puts and stuff like that inside my IRA is very nice. Being able to earn 30% returns on just cash that they're already paying me 5% on.
is that Vox? Would that be like a major feature that you would want, sort of, if in other words, Composer was to enable options? Would it be, or to the group? Like, what would you guys want if options were enabled? Would you want degen zero DTEs, or would you guys want safer stuff like covered calls or cash secured puts?
I mean, covered calls would be fun to backtest, but also, I don't think the majority of the people here are interested in putting zero DTEs in their algorithms unless they have some really solid theory on how they work.
Yeah, I don't know enough about options to be confident with them. I know the basics, but
So one use case you could do theoretically is, so options inherently give you leverage, right? They give you 100x leverage. Suppose you use a 0.7 beta option, that'll give you basically for every dollar that the underlying, let's say you have Tesla, right? Let's say Tesla's at $300. If Tesla goes up 300 to 301, your option, which costs maybe 10%, maybe $30, it'll control Tesla stock, but it'll move up 70 cents upwards. So you inherently get this insane leverage. So there could be strategies where, if it's a short-term trade, like maybe on the order of 1 or 2 days, you could theoretically leverage options. The biggest downside, so that basically, so most folks are using leveraged ETFs like TQQQ, which are like, I'm sure you've already gone over this, Garen, today. But you can now, let's say you only want Microsoft, or you only want a particular stock, maybe Oracle or whatever. I don't know that, and you want to leverage that because you just feel like you have some sort of algorithms. That's where you would kind of use options, sort of to help with. So you could use basically a 70 delta and kind of amplify your gain. So the biggest downside of options is the spread. So every time you buy and sell, you lose essentially 10% just to the spread, the bid versus the ask. That's a little more complex.
I mean, there's more downside than just the spread,
Yeah, absolutely.
Yeah, you lose value on time, you lose value on volatility, you lose value on option.
I think it would add a lot of complexity.
For very little benefit for Composer's intended user base. Because like one of the only things that they've ever actually told us in like certainty is that if you actually have the know-how to build an automated strategy using options, you're probably not the people that Composer was intending to target with their product. Like just simply, like you know too much about the stock market to be able to like be satisfied with what Composer has to offer. So like I don't see them ever actually offering options, but
yeah, I don't think
in a hypothetical world where they did, that would be very dangerous.
So not to divert, but like let's go back to the education side. Do you guys have any other questions on anything with building algos, with everything that we've covered so far? Like what, for my end, I'm going to be producing a lot of YouTube videos and some tutorials, and I'm building out the Wikipedia. I'm trying to create educational content to help educate you guys to get up to speed on building these machines. What would you like to learn more about, or what has been like the biggest issue that's holding you back, or issues with your portfolio? What kind of content can I create for YouTube or educational content for the wiki? What would you guys like to see?
I mean, some of the experiments you've done, like on the sort functions, sound pretty interesting. Like if you have any, conclusions around that, I think that'd be pretty interesting. But any other experiments you've been running and have some level of, results from would be awesome.
Okay.
Makes sense. Basically, just like a log of what we've found and whether it works or not. Just experiments we've run, our conclusions from those, more or less. Not even like a determination necessarily of what's good or bad. Just data dump, more or less.
Yeah. We all know it's like a limited sample size for everything, right? So
sure. Yeah, we're just two people in the end.
Okay, so Garen,
do what?
Sorry, are you generally going to be creating content more for Composer that applies most to Composer, or is it generic stock trading content?
I mean, I might get into other back trading and stuff, back testing, but it's going to be geared around Composer.
Got it. Because, well, some things that I think might be a benefit to have content around would be, maybe some things that Composer can't handle. More advanced kind of topics like trend lines and, liquidity traps and, stop. What do you call those? Some of those advanced topics. But I guess Composer, basically, if your education is more catered towards Composer, it wouldn't make sense, I guess.
Yeah. I mean, I would love to, but I'd have to get into PineScript and doing stuff like that. But I have been messing with getting ChatGPT to code me up some tools and stuff. That's been pretty useful.
So, Azir, I actually whipped something up really quick, just as like a super basic example of the the sort groups function that we've been talking about, it's zero testing. Don't put money into it. Don't do anything like that. But just like as a demo of the concept. I just took the groups for the different indexes out of Pareto's portfolio and threw them in a sort function just to like show the general idea, because it's basically a sort function within a sort function at this point.
Yeah, I think
not good.
So I think it's solid to have two sort functions. I've been theorizing this, and I think like the issue with the standard deviation, like you can select the one that's the most aggressive, but it's not necessarily the highest profitable one. So doing a standard deviation to select the most aggressive, and then another sort function to select the top RSI or something, would hopefully ensure. Well, yeah, I guess it goes back to you don't know how they calculate the RSI, but no, that should work. Anyways, I think a double sort function is a solid idea.
Yeah. So for the purposes of this very simple, very simple example, I'm screen sharing it if you want to go look at it. But it's like the top level is a 10-day cumulative return check, and it's going to grab the top 2 highest performing blocks. So depending on what's the top performing at the time, let's say we're in like a tech market bull run, we're probably going to grab the SPY, and we're probably going to grab the QQQ blocks because they have the highest density of tech companies. And then out of these blocks, it's going to take the 20-day moving average of returns, which is going to be similar-ish to the cumulative returns. So it's not really an ideal. You'd probably want some diversity in there. Like Aaron said, you'd want to grab like the RSI or the standard deviation of returns or something like that, just as an added layer of protection, more or less. And then it grabs the top 3 most performing stocks out of this. And I'll bet you money that if we scroll down to the back test, one of these gigantic spikes is probably the NVIDIA bull run after their report, where they said they were going to bump their guidance up like 50%.
Sure.
One of those spikes is probably in there, so it grabs stuff like that. And if you, I don't know what test the balancer is, so I'm going to remove that. But
interestingly, this strategy doesn't perform well until COVID.
Yeah. I think, just thinking about it logically, right? If, just using the NVIDIA spike as an example, like a 20-day look back or a 10-day look back is never going to be forwardly predictive of something like that, right?
Sure.
Yeah.
Maybe not the spike itself, but the follow-up after the spike, definitely.
Yeah.
And it also, just as like a general rule, the longer the look back, the less individual days are going to have an effect on any one given day's trade, which is why, as a general rule, when I'm building symphonies or recommending symphonies to people, is if it has like a less than 10 look back, I don't recommend it, because there's a couple people that have been running strategies that have like 5 versus 8 day moving average look backs, I think. And when those particular branches of logic are firing, the accuracy rate versus the back test is something like 40%. It's not good. It's bad. Like the sensitivity in the last 10 minutes when you're dealing with hyper volatile assets like triple leveraged tech stocks, it gets dicey in those last 10 minutes. And the other thing about this particular strategy, since you noted that it doesn't really take off until COVID, I haven't even looked at it that far back yet, if I'm being perfectly honest. When does it start? June 1st, 2017. But the entire theory around just the concept of like 80% of your moves are going to come from 20% of stocks. If you wanted to properly backtest this theory, you would have to go get the historical the historical makeup of the different indexes over different time periods, and then only look at the backtest for those time periods. So realistically, the proper way to be looking at this backtest would basically be from January 1st to now. And that's it. And then before January 1st, it doesn't mean anything because the makeup would have been different. At least I think. The top 10 stocks in the SPY changed this year, right? Something changed. I had to go look that up. But it should, in theory, be different. And if you go back far enough, it absolutely will be different because the top 10 stocks in the S&P 500 in the 90s are not what they are today. The top 10 stocks in the early 2000s are different than they were today. Early 2010s, completely different. 5-10 years ago, I guess that was early 2010s. But the point is, a strategy like this with the thesis of whatever the top stocks of the index are is not a set it and forget it strategy by any means. It's going to require maintenance, even if it's just once every 6 months to a year.
That reminds me of that book, Market Sense and Nonsense. They do a lot of statistical analysis on like what's best. Select the top stock over a 1 year look back, a 3 year look back, a 5 year look back. They do more longer time frames, but it's interesting. If you want to know those kind of statistics, it's interesting to study that stuff. My theory, I think what I want to do moving forward is just doing the sort functions, and you just let the algorithm figure it out. Like it'll select whichever is the top one. I think top RSI. I'm trying to think of like what metric would be probably the most robust over a 50-year window. I like RSI because it's a ratio chart. It doesn't matter if you're looking at an RSI in 1955 or 2023. RSI is just RSI. One of the downsides of cumulative returns is I guess it's still the same with cumulative returns, but I like ratio charts in general more than an exponential chart or a standard chart.
Yeah. You can generally get more consistent information out of them, in theory, because if it's just a number on a scale from 0 to 100, that scale of 0 to 100 is the same 100 years ago as it is now, in theory.
Does anybody else have any questions? I think we're going to wrap up the call. Yep, thanks guys for hopping in and asking questions.
Anytime. Yeah. Thank you everyone for coming today. I appreciate you.